Hey, I'm Ali from FX Scout. So our goals are to try help traders find the best start to their trading careers and then helping them find the best brokers for their trading needs and providing excellent trading education. Please watch until the end of this video. I'm sure you'll find it very useful, and please remember to subscribe and like. One of the most underrated yet time-tested candlestick patterns is the engulfing candlestick pattern. But what is it? Basically, it's a candlestick pattern that indicates a potential reversal in the market. You get bullish and bearish engulfing patterns. A bullish engulfing pattern occurs when a small red or bearish candle is followed by a larger green or bullish candle that completely engulfs the body of the previous candle. And in the Forex market, the close of the red candle is followed by the open of the green candle, and it usually occurs at the same level. However, sometimes in the stock market, you'll find a difference in the closing and opening prices. You might see a gap. Conversely, a bearish engulfing pattern is where a small green candle is followed by a large red candle that engulfs the green candle. Now, these are very powerful trading patterns because they signal a strong change of sentiment in the market. A bullish engulfing pattern generally signals upside moves, and bearish engulfing candles generally signal that the market is about to reverse and go down. And while many traders are quite efficient at spotting these patterns, it's not so easy to trade them. I use these candlestick patterns as potential buy and sell signals, but whenever I use them, I always ensure that I combine other technical indicators and technical factors to ensure that it is indeed a reversal that is about to occur. So, for instance, on a recent trade on the Swiss franc yen, I used the bullish engulfing pattern alongside three other technical factors: an uptrend on the daily chart, a pullback to a major level of tested structure, and an RSI moving above 50 to the upside on the 4-hour chart. So this combination provided a compelling reason to enter the trade, and it turned out profitably. So if we look a bit closer, firstly, you can see here on the daily chart that the pair is in an uptrend. There is also no resistance above the price, so it seems to have place for further upside moves. So if you go into the structure, here you can see a major level of resistance turn support that was tested multiple times. If we look at the 4-hour charts, then you can see that the RSI is moving above 50, which makes me think that there is an opportunity here for upside moves too. So once I see the engulfing pattern, which if I zoom in here is pretty clear, then I know that there is a bias to the upside, which is a good signal for a buy trade. I set my stop loss below this support level with enough space that I don't get stopped out by stop hunters. And then I set my take profit to a ratio of 1 to 1.5, and I wait for the trade to unfold, which it does, and it is profitable. Now, although this was a very clear-cut trading example and it was quite an easy one to spot, no one candlestick pattern is going to make you a successful or profitable trader. You have to combine different technical factors and fundamental factors and be aware of your risk management when you place a trade. If you're new to trading, please always start with a demo account to ensure that you get a feel for the markets and that you can practice opening and closing trades and perfecting your risk management. Thank you so much for watching. If you found this video valuable, please don't hesitate to subscribe and like. It helps us to understand what traders are looking for. And please leave a comment in the comment section below, and I'll see you in the next video.